Yesterday might have been the most glaring example yet of a short squeeze in the markets and some of the high-flying stocks separating from their fundamentals. Check out a few of these 24-hour moves in GameStop. You had Bed Bath & Beyond and National Beverage Corporation. Short squeeze, part of what's happening here, but doesn't explain the entire story. Some of these are story stocks, too, and we'll talk more about that. But joining us right now to make some sense of this is Chris Verrone. He's the head of technical analysis at Strategas Partners. And Chris, before we jump into some of these specific names, what are you seeing technically just overall in the markets? We've seen some huge push-ups. It seems like almost every day we're talking about new records that have been set by one index or another. And today it was the S&P 500 and the NASDAQ. What's happening overall?
I think we're seeing two things. I'd say, number one, this is still a really broad move. About 90% of stocks are above their 200-day. That is a broad advance. You typically don't get major tops from that. So we like how broad this is. Are you vulnerable to some type of a setback here? Probably. We're overbought. I look to about the 3620 area as good support. The second thing that we're seeing, though, and I think this is more important, we're starting to again see some leadership reversion. The things that haven't worked over the last 3, 4, 5 months, tech, FANG, NASDAQ, are starting to reassert themselves here. I think that's a big theme as we move through February into March and into spring.
All right, starting to see that. Let's talk about some of these big moves that we've seen in the names that we just mentioned, names like GameStop. What explains that? Is this a short squeeze? Is this something else that's happening?
You know, it certainly does have that speculative fever that would remind you of 99 or 2000. I think yesterday the range on GameStop was 150%. The range on BlackBerry was similar. The range on Express was very much up there as well. I think the question we have to ask as analysts is this speculative fever isolated to these few stocks, or is this something more symptomatic of a problem? And this is where I think we need to draw a really important distinction from today versus 99, 2000. When you were seeing the mania in late 99, we have to remember it was tech and nothing else. Tech was working at the exclusion of every other sector, of every other group. That's not the case today. There are these isolated pockets of extremes. There's no doubt about that. But this is a broad move. And this is not just a handful of stocks driving the whole advance. I think when you look at this from a bigger picture, you know, we've given people free money and free time. You're going to get stock prices up in that environment. But is this reflective of that 99, 2000 type speculative? I don't think we're quite there just yet.
Why? Well, I mean, what's the difference? Because you start talking about it, and I think about the day traders at that point, which are the same thing as the Robinhood traders now. People who are making fast trades may not know as much about a stock, jump into it because they see the momentum going, they see the flow going there, they like the story behind something and can understand that. That sounds an awful lot like what we saw back in 1999. You're just saying it's not as much of the depth of the market right now?
Yeah, I mean, I think one of the great stats, by the time you got to the March 2000 top, only 30% of stocks were actually working. Today, that number is closer to 90. So this market has a lot more depth behind it, a lot more breadth behind it. I'm not as concerned about these speculative pockets. Now, I also think when you try to quantify sentiment, and we look at about 7 sentiment indicators on a daily basis, only about 3 of them I would describe as very excessive here. Now, that's moving in the direction of sentiment getting too hot. But I do think what we're setting up here for is a market that's going to challenge the Fed. If the Fed is really serious on this idea that they're not going to raise rates until the unemployment rate is much lower or until 2023 or 2024, I have to wonder, is the market going to challenge that view? Is the market going to say, Chairman Powell, you're not going to raise rates until 24? What if the S&P has a 4 handle on it? What if 10-year yields are 175? So it does seem like we're setting up for some asset price inflation where the market is destined to challenge the Fed here.
Shepard Smith here. Thanks for watching CNBC on YouTube.